Introduction to Smart Money Concepts. Overview of Institutional Trading. Welcome to Module 1 of the Smart Money Concepts Trading course. If you're watching this, you've probably been trading for a while. You understand support and resistance. You know your candlestick patterns. Maybe you've even had some winning trades. But here's the question that brought you here. Why does it feel like the market is working against you? Why do your stop losses get hit right before the market moves in your predicted direction? Why does it seem like someone out there knows exactly where you placed your orders? Well, here's the truth. Someone does know. And in this module, we're going to reveal who they are, how they operate, and most importantly, how you can start trading alongside them instead of against them. By the end of this course, you won't just be another retail trader hoping for the best. You'll understand how institutions move markets, and you'll have the tools to follow their footprint. Let's begin. Let's address the elephant in the room. The statistics are brutal. Studies show that somewhere between 70 to 90% of retail traders lose money. But why? Most traders are taught to buy at support and sell at resistance. They're told to look for bullish patterns to go long and bearish patterns to go short. They place their stop losses just below support or above resistance, thinking they're being smart and protecting their capital. Here's the problem. This is exactly what everyone else is doing. And the market makers, the institutions, the smart money, they know this. Think about it. If millions of retail traders are all placing their stop losses in the same predictable locations, what does that create? It creates liquidity, pools of orders sitting there, waiting to be triggered. And institutions need liquidity. They're moving massive positions, hundreds of millions, sometimes billions of dollars. They can't just click buy and hope for the best. They need counterparties. They need your stop loss orders. So what do? They push price into these zones, trigger all those stops, accumulate or distribute their positions, and then the market reverses right after your stop loss was hit. Sound familiar? This isn't bad luck. This isn't the market being random. This is institutional trading. This is smart money at work. The retail approach to trading is designed to lose, not because retail traders are stupid, but because they're playing a game where the rules were written by someone else, someone with more capital, better information, and a completely different strategy. But here's the good news. Once you understand how institutions operate, you can stop being their liquidity and start trading with them. So who exactly are we talking about when we say smart money or institutions? We're talking about the banks, the hedge funds, the market makers, the large institutional investors who move enough capital to actually influence price direction. These are entities like central banks and their trading desks, major investment banks like Goldman Sachs, JP Morgan, and Citigroup, large hedge funds managing billions in assets, market makers who provide liquidity to the markets, pension funds, and sovereign wealth funds. These players don't trade like you and me. They can't. When you want to buy 100 shares, you click a button and you're filled instantly. When an institution wants to buy 10 million shares, that's a different story. They need liquidity. They need counterparties willing to sell to them. And they need to do this without revealing their intentions. Because if the market knew a major institution was trying to buy, everyone would front run them and drive the price up before they could complete their position. So they've developed sophisticated methods to accumulate and distribute positions, methods that involve manipulation, liquidity grabs, and strategic price movement. And this is where smart money concepts comes in. SMC is a framework for reading these institutional footprints in the market. It's about understanding their game and playing by their rules. Let's break down the fundamental differences between how institutions trade and how most retail traders approach the market. Retail traders look at price and think, it's going up, I should buy. Or, it's going down, I should sell. They're reactive. They're following price. Institutions think, where is liquidity sitting? Where can I accumulate my position? How can I induce traders to the wrong side so I have counterparties for my orders? Retail traders use technical indicators, moving averages, RSI, MACD. They're trying to predict where price will go based on past price action. Institutions create the price action. They're not predicting, they're participating in a way that allows them to fill massive orders at favorable prices. Retail traders place stops at obvious levels, just below support, just above resistance. Institutions target those stops. They sweep liquidity zones to fuel their entries. Retail traders think in terms of patterns, head and shoulders, double tops, triangles. Institutions think in terms of order flow, liquidity, and market structure. Here's a simple example. You see price bouncing off a support level 3 times. Traditional technical analysis says this is a strong support, so you go long with a stop just below it. But an institution sees something different. They see a pool of buy-side liquidity sitting above that resistance and a pool of stop losses sitting just below that support. They see an opportunity. They'll push price down, trigger all those stops below support, accumulate their long position from all those panicked sellers, and then price reverses sharply upward. Your loss becomes their gain. This is the game. And once you see it, you can't unsee it. Smart Money Concepts gives us a framework to identify and trade with institutional order flow. Let me introduce you to the core concepts we'll be diving deep into throughout this course. First, order blocks. These are the last zones where institutions place significant orders before a strong move. Think of them as the footprints institutions leave behind. When price returns to these zones, institutions often have pending orders waiting, which is why we see such strong reactions from these areas. Second, liquidity. This is the fuel that drives the market. Liquidity exists wherever there are clusters of stop losses and pending orders, above highs, below lows, at equal highs and lows. Institutions need to sweep these liquidity pools to fill their large orders. Third, fair value gaps, also called imbalances or inefficiencies. These are areas where price moves so fast that not all orders were filled. They appear as gaps on the chart. Price often returns to fill these gaps because institutions have unfilled orders sitting there. Fourth, market structure. Institutions don't just randomly push price around. They follow structure, higher highs and higher lows in an uptrend, lower lows and lower highs in a downtrend. But more importantly, we look for break of structure when that pattern breaks and change of character when momentum shifts. These tell us when institutions might be changing their bias. Fifth, premium and discount. Institutions don't buy at the top and sell at the bottom like retail traders often do. They buy at a discount in the lower part of a range and sell at a premium in the upper part. This is basic business sense applied to trading. And finally, inducement and manipulation. This is the psychology game. Institutions induce retail traders to enter positions, creating the liquidity they need, then reverse the market. Stop hunts aren't random. They're calculated moves to generate order flow. These concepts work together. They're not separate strategies. They're pieces of a complete picture, a picture of how institutions operate in the market. Now here's where things get real. Learning smart money concepts isn't just about memorizing new patterns. It requires a fundamental shift in how you think about trading. You need to stop thinking like prey and start thinking like a predator. Stop asking, where do I think price will go? Start asking, where is the liquidity and where would institutions need to go to fill their orders? Stop placing your stops at the obvious levels. Start placing them where institutions won't bother hunting. Stop getting emotional when your stop gets hit before a reversal. Start recognizing that as confirmation that institutions just swept liquidity and accumulated positions. This shift isn't easy. Your brain has been wired by years of traditional technical analysis. You've been taught to see the market one way, and now we're asking you to flip that perspective completely. But I promise you this, once you make this shift, once you start seeing the market through the lens of institutional order flow, everything changes. The markets start to make sense. The seemingly random stop hunts become predictable. The reversals become logical. You stop being the liquidity and start being the trader who follows smart money. So where do we go from here? This course is structured to take you from understanding these concepts theoretically to applying them practically in your trading. In the coming modules, we'll dive deep into each concept I just introduced. You'll learn how to identify order blocks with precision, how to mark liquidity zones on your charts, how to spot fair value gaps and understand when they'll get filled, how to read market structure like a professional, But more than that, we'll look at real chart examples, we'll analyze actual price movements, and decode what institutions were doing. We'll walk through complete trade setups from entry to exit. By the end of this course, you'll have a complete framework for analyzing the markets. You'll understand not just what to look for, but why it works and how to integrate it into a profitable trading strategy. This is your opportunity to level up, to stop trading on hope and start trading with understanding, to stop being the liquidity and start following the smart money. The institutions have been playing this game for decades. They have systems, strategies, and methods that work. And now, you're going to learn them too. Quick message before you go. If you're tired of indicators lagging behind price, tired of entries that look perfect but fail, and tired of feeling like the market is always one step ahead of you, this channel is built for you. Here, we don't chase signals. We study liquidity, structure, order flow, and intent, the same thing smart money watches. Every video is designed to help you stop trading noise and start reading the market the way institutions do. If you're serious about trading, not gambling, hit subscribe, turn on the notification bell, and join traders who want precision, not hope. I'll see you on the charts.